Well, there we have it. Tesla delivered better than what Wall Street expected. They announced earnings per share of $2.54 non-GAAP. If we take out the one-time items, you end up at $2.84. I don't feel so bad with my $2.69 forecast. Let's just go through a few things which I missed on so that I can learn and think about how to get more accurate in the future. If I didn't overegg the energy revenues, that business unit, then I would have been a heck of a lot more accurate with my numbers. So let's compare the key metrics and numbers. First off, yes, I was nearly 40% too high on the energy revenue. $400 million too high, in fact. Also, I had that business unit, the energy unit, actually turning a profit, which just wasn't the case this quarter. It didn't grow, it didn't make money. The good news is that I was pretty damn close on the automotive revenues and margins, within $250 million in revenue. So, in terms of total revenue, I was nearly $300 million too high, but as mentioned above, that's down to my poor ability to forecast the energy business. It's quite difficult really because they're not focusing on that, they're focusing on the cars, the EVs. The numbers are not stellar or spectacular if you just look at the numbers on their own and you don't dig down one or two layers or levels down. There are a few one-time things which have suppressed the numbers and will take analysts a few days to really appreciate them and factor them in going forward. Another thing to keep in your mind is that the CEO compensation item, so Elon's 2018 share bonus package, if you want to call it that, is done. There's about $65 million left, which we'll probably realise in this quarter that we're in now. That's it, done. That can have a big effect on 2022's numbers. We're in a place where the stock price and the stock market in general is not being rational. When's it ever rational, I hear you say? But how I find peace and sleep at night is just by focusing on the progress that Tesla and the companies that I'm invested in are actually growing as companies. So the growth, the efficiencies that they're driving. Take a look at this graph which shows revenue. There is no other big or mega cap company that is guiding growth at over 50% for the next 5 to 10 years. No one. Look at that revenue coming to fruition. What is more interesting was the call afterwards, which probably had a mixed reviews and reactions, with the confirmation of Cybertruck not going to be coming out this year, in 2022, and the talk around not actually working on a $25,000 car. The focus was to ramp those existing models, the 3 and the Y. At first I was taken back by that news, but after spending a bit of time thinking about it and sleeping on it, actually, when Tesla spoke about that $25,000 model nearly 2 years ago now, if you actually apply inflation to that $25,000, it's probably more like $29,000, $30,000 in today's money, right? So if we continue on that trail of thought, well, a Model Y could potentially be that vehicle once 4680 cells and structural battery packs are ramped and being used. The cost to actually produce a car could be way below that $30,000 mark. So let's assume they can produce the Model Y in maybe 2 years' time for $22,000 all in. Add in a 35% margin and the sale price to a customer will be $30,000. The key thing here is that yes, that 35% margin might seem really good now, but the real value is in the software. It was mentioned that this will become a large portion of revenue in the future for Tesla. I want to just play back from the call how bullish Elon was on FSD. Have a listen to this.
So over time, we think full self-driving will become the most important source of profitability for Tesla. Actually, if you run the numbers on robotaxis, it's kind of nutty. It's nutty good from a financial standpoint.
When Tesla does solve FSD, and Elon being potentially a bit too confident says by the end of this year, well, the actual physical car is not where the value lies, it's in the software. The cost per mile of transportation drops by like 75-80% overnight. Also, the value of that vehicle that has FSD grows, as you as an owner can send your car out to earn you money while you're not using it, while you're at work or while you're sleeping. Put it into the robotaxi network. Tesla will take a cut, just like Apple do with the App Store. But their mission is to accelerate their transition to sustainable energy, so they're not going to try and charge extortionate fees to do so. They want to help out the world. Most people were probably thinking that the call was going to outlay a more short-term view of the product roadmap. The Semi, the Cybertruck, the Roadster. But what they actually spoke about was FSD and robots, which are potentially a few years away now when we can actually see them. When I'm doing all my models, I'm not really factoring in much growth in energy or insurance. Zach, the CFO, was very bullish on the call, saying that insurance would grow at a faster rate than the car business. Granted, it's off a smaller base, I accept that. My share price is purely based on EV car sales and leasing. There is a lot more upside that I still need to try and quantify to realise the full value of Tesla, I think. Overall, it probably wasn't a great call for those that make simple discounted cash flow models and value Tesla as a car company, not as a technology company. I imagine, as we've seen the past couple of days, that the market won't appreciate what was said on the call. It was kind of too far out there. It didn't focus on 2023, 2024, 2025. In my next video, I want to go through a very simple back of the napkin workings as to what FSD or robo-taxis could do as a business model. The numbers are quite nutty. If you've enjoyed this video, subscribe to the channel and like the video. But until next time, stay safe.